Hi, and welcome to the Efficient Frontiers International Case Study Podcast Series. My name's Sam Sheen, and I'm joined by my colleague, Ramsay Weir. Today's case study is entitled The Amberscam, or the Gemcoin Scheme. As always, we'll start with just a little bit of background about the case. What we know about the Gemcoin case is based on the court materials that are available to the public, as well as a number of reports prepared by the receiver who was appointed after the scheme was discovered. The first aspect to this case is it involves a pyramid or Pira Ponzi scheme, as we like to call them. So it's basically a multi-level marketing scheme that encourages investors to recruit other people, supposedly with the aim of receiving certain goods or services. But at the end of the day, they never exist, and investors are defrauded of millions of dollars. Now, in this case, our main character is a gentleman by the name of Mr. Chen. And earlier this year, he agreed to plead guilty to charges of conspiracy to commit wire fraud, tax evasion, and in total, the amount defrauded from investors in this case was $147 million. Now, let's start from the beginning. What did this scheme involve? The scheme was premised upon a joint venture created between the United States and China, and it was referred to as the U.S.-China Consultation Association. And its main operations were facilitated through a company known as USFIA Inc. Now, Mr. Chen was described as having a really key role in the operation of this joint venture, and the title that he presented to people, which he held, was the Undersecretary to Secretary of States of the People's Republic of China. Mr. Chen was not alone in supposedly running this joint venture. There were a number of other individuals who it was alleged were either promoting or had some control over this organization. And they included supposedly the nephew of the president of China, the son of a former military commissioner of the Communist Party, a US congressman, and even one of the mayors in the city of California. Ramsay, just wondering what your initial thoughts here. If you were doing due diligence on this entity, say it was looking for a bank account,
the positions held by these people would certainly qualify them as PEPs, as politically exposed persons. And this would be a red flag for any financial institution, as these people are more open to corruption and bribery. And we would need to know more information about their source of wealth and verification.
And then we have another interesting fact here about Mr. Chen. He holds himself out as being the founder of China Unicom. Again, from a due diligence perspective, Ramsay, what are your thoughts on this one?
China Unicom is a huge global company. We should be able to verify this information through public sources and understand Chen's role or the other's role in any of this if he has one. If this information was provided to investors, it would certainly be comforting that the person in charge has previously had successful business ventures and that the money that they provide to him be safe as a sort of trusted individual.
And interestingly, with this case, although we have these facts, they weren't actually, as far as we know, provided to any of the financial institutions involved. The main source for these bits of information were actually the promotional material brought to the investors themselves to encourage them to invest or basically give away their money to this scheme. I'm wondering, Ramsay, when you're doing your due diligence on funds or investments, I mean, how often do people actually ask for the promotional material that's distributed to investors?
Typically, unless it's publicly available through a website of some sort, we would not review the promotional material or certainly not request it. Material is for a different audience.
With this material, there were some other challenges, even had the financial institution sought them out. And one example of those challenges is that in seeking to attract investors from China, a number of these materials were actually printed in Mandarin or Cantonese. We know that the scheme was promoted as being a collaborative effort between China and the US, that it supposedly had 50 billion in assets under management through that structure, the USFIA, and apparently they had previous experience in obtaining golden visas. So as part of the scheme, they would encourage people to go and recruit more investors. And people who recruited the highest proportion of investors, who got to the top of the pyramid, they would be entitled to some sort of golden visa that would allow them to come and live in the United States and live in a property that they planned to build next to a golf course. So what is it exactly people were investing in? Well, the proposal was that investors would provide their money. In turn, they would receive some units in this USFIA structure. And then USFIA was going to use the money to invest in amber mines. And they suggested there were mines that work in Mexico, Argentina, and the Dominican Republic. So, well, in step two, the investors are told that they'll be able to exchange those units one for one with common shares in USFIA. Why? Because they propose that there will be an IPO. Everyone will get a minimum of a $20 value for the shares exchanged for the units, and that once the IPO is launched, people can expect to see an increase in their initial investment of up to 64%. And not only that, they'll receive a certain amount of actual amber, up to 30% of their initial investment. Why are all these elements relevant for this particular scheme? Well, first off, the IPO is really important, and this is a tactic that's been seen in other fraud cases like OneCoin. So, Ramsey, do you just want to talk through what an IPO is and why it's relevant here?
Sure. So IPO, or an initial public offering, is where a private company issues shares to be sold publicly for the first time to public investors. In this case, an enticement of greater returns because people are expected to receive more money off the back of the public listing. Because an IPO puts the fund on a stock exchange, so it will appear that the shares will be publicly traded in the future, and shares are often sold at a discount initially during IPOs, so that the increase in value from when that they were purchased during the IPO.
So it really gives the investors then a false sense of comfort because people have the impression that if a company is listed publicly, it must be okay because somebody's overseeing it and making sure that what it's actually engaging in must be legitimate, right?
Right. Yeah. So there's a certain regulatory and like disclosure obligations for listed companies. They publish reports of all their financials annually. They go into a certain amount of detail, and these reports will need to be audited when published by an independent third-party accountant. So
And then let's talk about the 64% return.
right. So this is a big red flag for me personally. Completely unrealistic even for the most successful of IPOs. And this goes completely against what legitimate investment firms would be saying in their materials. As in prospectuses reviewed by investment managers for funds, they go out of their way to sort of legally cover themselves and not receive complaints, to not guarantee any profit on your return.
All of this is designed to make sure the initial investors remain motivated and keep going out and recruiting even more investors. So receiving the amber is almost like a guarantee to them that this is really happening and amber is actually being mined. So again, it's this presentation of enticement, if you like. The folks running this say, well, the IPO has been canceled, but don't worry. Instead, we are going to exchange your units with some Gemcoins. Now, why do they do this? Because you can imagine if you were told the IPO is canceled and you're just holding these units, you're going to start to get a little bit suspicious. And when you want your money back, you won't really know how it's going to happen. And you could complain to the authorities. That then blows the whistle on the whole scheme. So what you want to do is stop people doing that by offering them an additional inducement. So in this case, what they've done is they've offered them what sounds like some form of cryptocurrency in exchange for those units. The company itself doesn't create the gem coins. These are cryptocurrency that has been underwritten by a company called Alliance Finance Group, Inc., who hold a fund called the US FIE Currency Fund, and that's where the gem coins are held. Why even mention that these are going to be underwritten, Ramsey?
So when doing an IPO, the investment bank commits to buy all of the shares that they've committed to selling. So by being underwritten, it ensures that the value stays solid and it will maintain its value. So for example, if they can't sell all of the shares, they've still committed to buy the others, so they have an interested party keeping them. If the underwriter does manage to sell all of the stock, it makes it look like it's generating good supply and demand for the stock. It's likely to keep the value of the stock up.
So essentially, this is a very clever means of, again, giving these folks some false comfort. But there needs to be some credibility behind this story. And so what they do is they explain that this Alliance Finance Group is quite reputable.
Investors are told that Alliance Financial Group is very successful as an underwriter and asset managers with 500 million assets under management and a network of over 2,000 business associates. The portfolio that they allegedly manage here is also very diverse, including aerospace, agriculture, mining, gems, real estate, IT and these gem coins. Whereas in actuality, if you look at legitimate investment managers, it would be very unusual to see a portfolio of assets under management so diverse. And they like to specialize and be experts in their fields to maximize returns. Actually, I misspoke. It was not 500 million in assets, but actually 500 billion in assets they claim to have under management.
It appears an additional tactic was used here. They had a really common name, didn't they, Ramsay?
They did, whereas not. There were 83 companies of the same name found on Open Corporate. It's not uncommon for large asset managers to have a series of similarly named entities, but big firms would make sure that there are slight differences between parallel investment vehicles or managers and not have these names be identical. From a KYC perspective, if we were dealing with an investment manager, we would be looking for confirmation with public filings or in an investment management agreement between the manager and the fund to verify that the manager who wants the account is in fact the same one shown on the company register. As this is a US investment manager and should be regulated by the SEC, would have everything publicly available on IAPD, this proof of regulation and all of its private fund reporting. So you'd be able to publicly link this manager to the fund in question. Unfortunately, very few other countries have this level of private fund reporting. So we would have to rely on an official document with an investment management agreement from the manager itself to link the entity.
The investors are told that their gem coins allocated to them in exchange for those units will be kept in an e-wallet maintained by the US FIA. Now, why do they do that? Because you essentially don't want these people to actually ask to hold the gem coin because they'll discover it doesn't actually exist. It also allowed the scheme organizers to manipulate the prices as they saw fit.
So as this is a case from 2013 where all of this was actually going on, a lot has changed.
They say, but that's okay because you can withdraw or sell your gem coins within 60 days of you investing. And in fact, you can sell it to other investors at an online auction facility that will be maintained on the US FIA's website.
Yeah, so to me, there are a couple of red flags here. If, as the company says, they're investing in assets like mines, these tend to be closed-ended private equity funds, and the money is used to invest in assets that are illiquid or difficult to convert quickly into cash. The idea that you can withdraw or sell within 60 days of investing does not reflect what you would see of a closed-ended fund. Typically, you'll see 180-day at least commitment periods, as the investment manager needs to be confident that they'll be able to invest the capital raised into longer-term opportunities, and they can't have the money disappearing from the fund. Also, the ability to sell to other investors an online auction facility on the US FIA's website is odd, because this suggests that the investors can engage in secondary trading. The asset manager will want some visibility over how many coins, in this case, any one investor holds. Ordinarily with shares, this relates to how much control a single investor might have over a fund. Typically, a fund manager wants a diversified pool of investors so that they're not reliant on any one investor should they decide to withdraw their contribution. The fund would also, if adequately regulated, be required to report beneficial ownership at 25% thresholds, and in some cases even a 10% threshold, and it would be very hard to keep track of this.
A promise was again made: if you hold tight and hang on to your gem coins, in 2 years' time, we will proceed with that IPO. But that wasn't all, because not only could you obtain these gem coins and you receive some amber, but you could also in the future use a Gemcoin global debit card, which could be used at ATMs or cash machines, as we call them here, that would be located all over the world. And apparently there were plans for over 2,500 of these machines to be installed globally. Well, surprise, surprise, the scheme was eventually discovered. It started off with some investors complaining who were not able to cash in those gem coins as promised. So a prosecution commenced. Freezing orders were made to freeze the various bank accounts where the assets were held, and a receiver was appointed. Turns out there was no fund and there were no gem coins. And I suppose we'll start off with a rather colorful fact, which was at the time the receiver was appointed, they went with the US Marshals to the Gemcoin company offices where Mr. Chen arrived, and they were there obviously to take control of the company and obtain the records and so forth. As the receiver reported, apparently Mr. Chen was wearing a security guard uniform and carrying a loaded gun, which he had not concealed. The U.S. Marshals seized the weapon from him and also found over $46,000 in cash stashed away in his car. So what we're going to look at here is how the money flowed in from these unsuspecting investors, and then how the money was used by Chen and his associates. So to give you some idea as to the scale of this case, we're talking about a total of 83 bank accounts involving one bank predominantly. There were only 3 men signatories on most of these accounts, and in total, approximately $204 million was received as inflows from investors, and then approximately 183 million was dispersed, laundered, and then used by Chen and his associates. It left about 20 million in these accounts, which at the time of the receiver's appointment were frozen. So let's talk a little bit about the inflow. And the idea was not only to give legitimacy to the fund, but also to muddy the trail of where the money was going. So the first thing they did was they made sure that the funds being received from our investors were commingled between approximately 12 related entities. And that resulted in about 400 transfers worth about 74 million alone. I mentioned they had lots of bank accounts. Well, some of those entities had multiple bank accounts, and they didn't appear to have any apparent business purpose. But we'll flesh that out in just a moment. Essentially, the money was moved around what appeared to be to meet the liquidity needs or the source of funds for the various entities, because some did pay commissions to the initial investors to keep them motivated. In order to receive the funds, for those of you who can't see the slide, we're going to talk through this slowly. For those of you who can see the slide, it'll be a bit easier to follow. A series of companies were set up, or existing companies that already had been incorporated were used to accept funds from the investors. The next important element were the bank accounts. So bank accounts needed to be opened or controlled by Chen or one of his associates, hence why there were mainly 3 signatories on all the accounts. But the third essential step was that investors then needed to be told where to send their investments. The final step was, how are we going to manage the inflow of cash? They developed a strategy whereby different entities would receive the money. So that meant investors, when they went to make an investment, would all receive different payment instructions. So they would have different bank information.
Right. To me, particularly the names of the entities which are used are interesting. So if we just go around the diagram here, we have Amkey Inc., A-Home Real Estate LLC, Apollo REIT 1 LLC, Quail Ranch Golf Course LLC, Apollo REIT 2 LLC, and Am Auction Inc. Firstly, if we look at the 2 REIT entities, the REITs, these stands for a Real Estate Investment Trust. These are investment vehicles for commercial real estate activities. So they're intended by name to look like fund vehicles. This is clever because both the investors submitting the cash and the bank who opens the accounts would believe that the nature of the business is investment in real estate. Sort of just helps tell a story, Usually in KYC, at least in 2020, we go a little behind just the name of the entity. It's also clever that 2 companies, Quail Ranch Golf Course, as this one in the promotional materials was the place where you would live if you sold lots of friends on investing into the scheme, and got the one of those 1,600 golden visas, as well as the A-Home Real Estate LLC, which is doing much of the same thing.
I mentioned before about multiple bank accounts and that there was one particular bank who was involved. Well, it turns out when we broke down the bank accounts between those companies that we just mentioned, a lot of them owned more than one bank account, sometimes at the same bank, or they might hold a couple of them in a different bank. Now, there's an interesting term that's used by some private banks, and they call them household clients. What that's intended to describe is you have one client who's maybe the beneficial owner of a company, but they operate a number of different companies. So what they do is they try and interconnect the information about them on their customer relationship system. So that way the KYC can be read across. It's designed so that you understand the customer relationship for business purposes. So in this case, once Mr. Chen was able to open a couple of bank accounts, he could continue opening more bank accounts for entities with different names. And the bank already had a false sense of comfort because they'd opened some initial accounts for him. The second thing is that the transactions that move between US FIA and some of these companies happen within the same bank. And so why would a bank question its own KYC and transaction monitoring process, right? We're going to talk about a couple of the entities identified just in terms of how they were actually used. Amkey. So what's the deal with this one? Again, Chen controlled this one, but his brother was the manager. And it turns out his brother also operated a multi-level marketing scheme. And this time he was selling vitamins and dietary supplements in Asia. You're probably wondering, well, how does that help to disguise the funds that were received? Well, it's actually quite clever because you can imagine investor funds were coming in different amounts and at different times. So it could very well just look as if these people were buying the vitamins from the vitamin company. And because he was using those funds then to pay payroll, vendors, and rent, the outflows probably didn't look that unusual either, given what the nature of the business was that his brother ran. And then we have the real estate entities.
Earlier, we talked about the real estate investment trusts and that they would receive investor funds and be involved in commercial real estate investment activities. So if these were legitimate real estate funds, they would have the outflows to purchase the real estate that was the target objective of the fund. So these would be large, sort of one-off payments. It appears from the bank records that Chen had sole control over all of these accounts.
So these are two different real estate entities. There's A-Home Real Estate LLC and there's A-Home Real Estate USA LLC. We went on Open Corporates and we can see that Mr. Chen has set these up. They have slightly different registered addresses. And again, if these were accounts that were being opened by Chen at the banks he already had bank accounts with, there's a chance that they would just presume, okay, well, these don't have any activity yet because they're going to hold some type of investment, right?
Right.
But if this was regulated, what would you expect to see on the bank account? Because here we just had Mr. Chen on it.
So generally, as they're involved in commercial real estate activities, the outflows would be large acquisitions of real estate, so like office buildings or properties. And then depending on which real estate assets have been bought, the inflows would then differ. If you buy, say, like an apartment building, the inflows would then be rent from the tenant.
So we had 6 other companies.
Sure. So we have Arboral Realty Advisors LLC, Arboral Management LLC, Apollo Investors LP, Arboral REITs 1 and 2, and Arboral Realty Corporation. So here we basically have entity names that all seem to be involved in real estate investment activities. So we have an asset manager, we have an SPV in the investor entity, and we have more real estate investment trusts. So depending on how the flow of funds coming into these companies appeared, they may not have raised red flags at all on the transaction monitoring. The investment manager would receive fees and commission and have outgoing operational expenses. And this applies for the Realty Advisors entity and the management entity. The SPV, Apollo Investors LP, could be made to look like a limited partnership through investment in a fund held for an investor. So you'd expect the flows in and out of these to reflect the expected activity of the fund. So if it was a closed-ended real estate fund, you would not expect very much activity for a couple of years after closing, and then maybe you would get some outgoing to pay for calls on further capital commitments, on inflows from dividend payments, and possibly some activity when the fund is matured and liquidated at the end of its life.
Another outflow tactic used was in relation to an entity called Alliance NGN Inc. It's been used as one of the flow-through entities. So the money goes through it to another one of the entities we've mentioned named Amkey. It's almost like it's a play on Amber. So it might give investors or banks the impression it's somehow affiliated with this Amber program, although we know the banks weren't aware of the scheme itself. But then those funds were used to fund A-Home Real Estate. We're concealing the source of the funds. We're flowing it through an account held by Alliance. It goes into an account held by Amkey. Further funds are brought in by A-Home Real Estate. Even though 7.7 million was received into this account, it was mainly used to finance Chen's personal expenses. Given the sort of uncertainty about the name, it's not really clear what this entity would do. It wouldn't necessarily have raised red flags for the money in that account to be used the way that it did. So we get Am Auction Inc. Again, remember the thing I said about Amber, they talked about having an auction facility for the Gemcoin. So, for investors who are asked to pay into that, it probably sounded like it was affiliated in some way with the fund. And the receiver discovers that a payment of 13.4 million has been made to a company called Amin SRL. When we look at the description for this entity, we find out that there is sort of a bit of mining activity going on here in the first place. Receiver was able to discover that this Amin SRL company is actually incorporated in the Dominican Republic. And while investments had been made in a blue amber mine in that country, actual ownership of the property wasn't registered to Amin itself. But it does turn out it was controlled by a member of the Chen family. There was very little evidence of actual formal mining going on, but in total, that entity received 12.8 million of transfers originating from those deposits made by investors. And then we get the card machines, right? Sorry, we get the credit cards and the card machines. And it turns out there were two of them located in the Gemcoin office we mentioned where Chen was arrested. It turned out only one of them was actually plugged into the wall, and none of them were connected to any financial institution. And when the receiver was able to open the machines, they discovered there was only $100 inside. So what sort of things did Chen and his associates spend the money on? A lot on real estate, a 112-room hotel. They had an entertaining mansion. And they also recovered jewelry from the offices as well. So that amber we talked about that was sent to all the investors, well, they had these large bins full of silver rings with paste that had been used to create stones that look like they were amber. And finally, there were other payments that were made to family members as well. There seem to be some open questions in this case about the transaction monitoring. Now, as Ramsay has explained, depending on the flow and the timing of monies coming in and going out of some of the entities that appeared to be associated with a fund or a fund vehicle, it would be really difficult to detect any illicit activity going on. But the facts do show that in terms of some of the outflows coming out of Alliance, A-Home Real Estate, and USFA, things are being bought like groceries at Whole Foods, buying cars like Porsches, using the money to go gambling, and even buying furniture for the house. So it's really open to question whether the main bank involved just thought because it was the same guy involved in all the different companies that they weren't alerted to the fact that there were some very odd uses of these supposed commercial accounts going on for personal use. We are told by the receiver that a large number of the investors in this scheme were located in China. Although they've advertised on the internet asking claimants to come forward, they've only received 7,500 claims to date. They've discovered that for the investors in China, it is difficult to get access to the internet. Many have been forced to use VPN networks. But more seriously, what they discovered was that many of them use third-party intermediaries in order to make the investments outside of China. The receiver reports that due to the very strict laws and regulations in China, it appears that some of these folks use these intermediaries to get around those regulations, but that those intermediaries also took advantage of those investors, providing them with conflicting and inaccurate information. And because they fear repercussions from the Chinese government, the US immigration authorities, and even tax authorities, very few of them have actually come forward to make a claim. It's an interesting case, Ramsay. What's your thoughts?
Just a couple of things that I would note to take away. The incorporation of the entities I found a little odd, particularly when they were incorporated. So generally, regulated investment managers would incorporate these SPVs for exactly what it stands for, a special purpose, as their special purpose vehicles. So they would be incorporated at most 6 months before they would be used for these purposes. However, we had some of the entities incorporated even as early as 2003. So they've just been laying dormant until they were actually used for these purposes, which is, again, not particular of professional investment firms. And just a second point, how investors may be able to avoid schemes like this in the future. I know that Chen went to certain lengths to obfuscate and make it more difficult to actually look up his companies and his investment manager. But you can still do some personal research, and a lot is reported publicly, depending on jurisdiction. Look for a proof that the investment manager is regulated in the country of incorporation. So in the US, you have IAPD, the Investment Advisor Public Disclosure, where SEC regulation and various other reporting is documented, and other recognized regulators in other countries for other cases. It'll be a really good foundation, I think, for just to make sure investors can actually rely on publicly verified information and know that they're giving their money to a trusted source.
And with that, I'd like to thank Ramsay for taking the time out to participate with me today in this podcast. So if you would like to ask more questions about this case study, or if you have any due diligence, monitoring, or investigation work that you might need some assistance with, feel free to reach out to our colleagues, Lizette Smith-Cullen or Russell Taylor, via LinkedIn, or you can go directly to the EFI Limited.com website. Thanks for listening.